Have you ever wondered how to win on the financial market? A question that echoes in the minds of many. To answer this, we first need to understand what financial markets are. Essentially, financial markets are arenas where buyers and sellers trade assets such as equities, bonds, currencies, derivatives, and even commodities. They play a crucial role in the overall economy by providing companies with access to capital and investors with a slice of ownership in these companies and a fair return on their investment. The financial market universe is vast and diverse, including stock markets where company shares are bought and sold, bond markets that deal with debt transactions, commodities markets for raw or primary products, and derivatives markets for contracts based on underlying assets. Each of these markets operates under different dynamics and carries unique opportunities and risks. Now that we understand what financial markets are, let's dive into how we can win in these markets. One key to winning in the financial markets is understanding market trends. Market trends, in the simplest of terms, are the general direction in which the market is moving. They are formed based on supply and demand, driven by various factors such as economic data, geopolitical events, and market sentiment. The significance of market trends lies in their ability to provide insights into potential future market movements, helping investors make informed decisions. There are three primary types of trends: uptrends, downtrends, and sideways trends. Let's delve a bit deeper into each of them. An uptrend, as the name suggests, is characterized by prices that are on the rise. It's like climbing a hill, where each new peak is higher than the last, and each new trough is higher than the previous one. This indicates a strong demand and bullish sentiment, and is a cue for investors to consider buying. On the flip side, we have downtrends. Picture walking down a hill, where each peak is lower than the previous one, and each trough is also lower than the last. This signals a bearish sentiment where supply exceeds demand and could be a sign for investors to consider selling. Then we have sideways trends, also known as horizontal trends. Imagine walking on a flat path with little to no incline or decline. Here, the peaks and troughs are at approximately the same level, indicating a market in equilibrium where supply and demand are evenly matched. This could suggest a period of indecision or consolidation, and investors might take a wait-and-see approach. By identifying these trends, investors can adapt their strategies to align with market movements. An understanding of trends can provide an edge, allowing investors to anticipate potential opportunities and pitfalls. However, it's important to remember that trends are not foolproof predictions, but rather tools to guide decision-making. Identifying and understanding these trends can be the first step to winning in the financial markets. Education is a critical component of success in the financial markets. When we talk about education, we're not just referring to the conventional schooling system. We're talking about a broader, more self-driven concept of learning. This holds particularly true in the realm of financial markets, where knowledge truly is power. Let's put it this way. Imagine you're planning to climb Mount Everest. You wouldn't just wake up one day, pack your bags, and start climbing, would you? No, you'd spend months, maybe even years preparing. You'd learn about the terrain, the weather conditions, the best routes. You'd train physically and mentally. Why? Because you know that going in unprepared could have dire consequences. The same principle applies to the financial markets. You can't expect to navigate the complex world of stocks, bonds, commodities, and currency without a solid foundation of knowledge. Firstly, financial education helps you understand the jargon. Terms like bear markets, bull markets, short selling, and arbitrage might sound like a foreign language to the uninitiated, but understanding these terms is crucial to understand the dynamics of the market. Secondly, financial education keeps you up to date with market trends. The financial market is a dynamic and ever-changing beast. What worked yesterday might not work today. By staying educated, you can stay one step ahead of the game. Lastly, And perhaps most importantly, financial education helps you make informed decisions. Without a proper understanding of the market, you're essentially gambling. But with the right knowledge, you can analyze the risks and rewards and make decisions that align with your financial goals. So how does one get this education? Well, there are plenty of resources out there. Books, online courses, seminars, podcasts. The list is endless. It's all about finding what works for you and committing to continuous learning. In conclusion, financial education is not just important, it's essential. It's the compass that guides you through the treacherous terrain of the financial market. It's the tool that turns the odds in your favor. Arming ourselves with the right knowledge can significantly increase our chances of winning in the financial markets. Risk management is the backbone of any successful trading strategy. This statement holds true across the board, whether you're a seasoned market veteran or a novice just dipping their toes into the financial waters. But what exactly is risk management? At its core, risk management is the practice of identifying potential risks in advance, analyzing them, and taking precautionary steps to reduce your exposure to these risks. In the context of financial markets, this involves a careful balance of potential profit against potential loss. Now, one of the key tools in the risk management toolbox is the risk-reward ratio. This ratio is a measure of the potential profit you could make in a trade relative to the potential loss. Essentially, it's a way of quantifying how much risk you're willing to take on in pursuit of a particular reward. For example, if you're looking at a trade that could potentially net you $100 but could also potentially lose you $50, your risk-reward ratio would be 2 to 1. This means you stand to gain twice as much as you stand to lose. But how do you minimize losses? This is where stop-loss orders come in. A stop-loss order is an order placed with a broker to buy or sell a security when it reaches a certain price. It's a way of saying, if the price hits this point, cut my losses and get out. This can help limit your losses on a bad trade, and it's a crucial component of risk management. Keep in mind, though, that risk management isn't about eliminating risk altogether. That's impossible. Instead, it's about understanding the risks, managing them, and making informed decisions based on that understanding. It's about recognizing that every trade carries a certain amount of risk and determining how much of that risk you're comfortable with. When it comes down to it, risk management isn't just a tool for the financial markets. It's a way of thinking, a mindset. It's about being prepared, being informed, and being ready to make tough decisions when they're called for. Effective risk management can often be the difference between winning and losing in the financial markets. A solid trading strategy is a must for any serious market participant. This is a golden rule in the world of finance, and for good reason. Without a plan, we are essentially sailing in the vast ocean of financial markets without a compass. Not only does a trading strategy provide us with a sense of direction, but it also helps us manage our risks and maximize our potential gains. Now, there are several types of trading strategies based on different time frames and trading styles. Let's delve into them. First, we have day trading, swing trading, and position trading. Day trading is a short-term strategy where traders buy and sell financial instruments within the same trading day. They aim to capitalize on small price movements and avoid overnight market risks. Swing trading, on the other hand, involves holding positions for a few days to weeks. Swing traders try to capture short-term trends and are less concerned about daily market fluctuations. Position trading is a long-term strategy. Position traders hold onto their investments for months or even years, focusing more on the fundamental aspects of the market rather than short-term price movements. Next, we have different trading styles: momentum trading, breakout trading, and reversal trading. Momentum traders ride the wave of market trends, buying when prices are rising and selling when they are falling. Breakout traders, meanwhile, focus on price levels that a market has not been able to surpass, betting that once the price breaks these levels, it will continue to move in that direction. Reversal traders, as the name suggests, look for signs that a current trend is about to reverse. They aim to buy at the bottom and sell at the top, making profits from market turnarounds. Each strategy has its own merits and pitfalls, and what works for one trader might not work for another. It's essential to choose a strategy that aligns with your financial goals, risk tolerance, and time availability. A well-thought-out trading strategy can guide our trading decisions and help us win in the financial markets. Remember, success in trading isn't about hitting a home run every time. It's about consistent singles and doubles over the long term. Winning in the financial markets is not a matter of luck, but a result of careful planning and execution. Let's take a moment to review what we've discovered on our journey. We began by understanding the intricacies of financial markets, an essential stepping stone towards success. Recognizing market trends came next, a tool that allows us to anticipate movements and make informed decisions. We emphasized the importance of financial education, a foundation that empowers us to navigate the volatile seas of finance with confidence. Our conversation about risk management reminded us that every investment comes with potential downsides, and it's our responsibility to manage these risks proactively. Developing a solid trading strategy was our final stop, combining all our knowledge and tools into a cohesive plan. It's not just about the destination, it's about the journey. So, equip yourself with the right knowledge, manage your risks effectively, and have a solid trading strategy. That's how you win in the financial markets.